We've been in a market where global interest rates have benefited from falling inflation and a strong commitment by global central banks. This period of a bull market in global interest rates, we believe, is coming to an end. What we're about to embark on now is a period of rising rates gradually over time. I think in the near term, low inflation and relatively below trend growth on average will keep rates from spiking. However, given the aggressiveness of central banks, there is a big uncertainty as to what the direction of interest rates could be and the potential for interest rates to rise fairly significantly, perhaps even over the near term, depending on how central bank policy evolves. So I think one thing we can say is that the global bull market interest rates may be nearing an end, and the question now is not will rates rise, but really how much and how fast will interest rates rise from here. Quantitative easing is a term used to describe the purchases by central banks of bonds in the market. In the case of the United States, for example, the U.S. Fed has been purchasing a combination of U.S. Treasuries and U.S. mortgage-backed securities in an effort to keep interest rates low. And they've been largely successful in keeping interest rates low with the attempt to help spur credit creation and loan growth in the economy. As the economies have recovered from their post-crisis lows in terms of economic growth, central banks are keen to taper or withdraw the amount of bonds that they're purchasing on a regular basis in the markets. So tapering is really a word used to describe a slowdown in the amount of bonds that are being purchased by central banks, in particular the Fed. So the real question here is, as the Fed begins or other central banks begin to slow the rate of their purchases of government bonds or mortgage bonds, that's less demand in the market for these securities. Less demand might mean lower prices or higher yields. So as central banks have been key buyers of fixed interest securities in various forms through quantitative easing, as they begin to taper those purchases or back away, this could mean less demand and hence potentially higher interest rates going forward. A defensive yield fund, the difference between a defensive yield fund and a global fixed interest fund, I think really you can see a lot of the difference in the name. So a defensive yield fund will be positioned defensively in periods of rising interest rates. If you look at most fixed interest funds out in the market today, one of the primary risks that exists in those funds are the direction of interest rates. Meaning if interest rates were to rise significantly, general global fixed interest funds may do poorly as bond prices tend to fall as interest rates rise. The real difference between those funds and a defensive yield fund is that the defensive yield fund is positioned so as to protect an investor from periods of rising rates. So a term that's used is duration, which is the sensitivity of a fund to a rise in interest rates. A defensive yield fund is managed so as if interest rates rise, that should not necessarily mean a negative return for the fund. The fund is using other tools besides interest rates to deliver the fund's return, and hence is more defensive from a yield perspective. The corporate bond market has evolved and expanded over the years. I think when thinking about corporate bonds, you do have to differentiate in the market between those of high quality companies and those of potentially lower quality companies, and part of that's reflected in the rating of the bond. In general, what I can say is corporate bonds offer a very valuable source of excess return in the fixed income markets. Over the years, what we've seen, again since the financial crisis, is a rebuilding of corporations' balance sheets. They've become a lot stronger on average, and also earnings growth has been quite strong globally. That's a nice backdrop in terms of the ability of these corporations to repay the debt that they've issued. So I think the fundamentals look fairly good for corporate bonds. I think when investing in corporate bonds, you have to do the research on the individual names. There's lots of opportunities in corporate bonds to do well. It's also a sector where if you invest incorrectly, you could do quite poorly. So I think credit research and credit work is the key for corporate bonds. If you can do that, we think there's lots of opportunities in the corporate bond market today. The term emerging market bonds is an interesting term. One could argue that many quote-unquote developed market nations are in fact emerging, and perhaps some emerging market nations are in fact developed. The fact of the matter is, I think it's difficult to generalize emerging markets into one broad category. What I'll say about the quote-unquote emerging market bond category is that much like corporate bonds, research is key here. Countries within this space can vary dramatically with respect to their governments, with respect to their pace of economic growth, with respect to the ability for them to fund themselves internally versus rely on external flows for their funding. So having said all of that, what happens in the market is people tend to generalize with emerging market bonds, and in periods of stress will sell everything. So if you can identify which countries have the ability structurally to maintain stability in a period of stress, you can find compelling valuations in the market today in countries where the bond market has been thrown out, throwing the baby out with the bathwater, so to speak. And right now we believe those opportunities exist. We're focused on countries with strong fundamentals, which are in a better shape to fund themselves versus heavy reliance on external demand and external flows. So we think there's opportunities in the emerging markets, but you really have to tread carefully and really not bucket the entire space together. The new Prime Minister Abe was elected late last year in Japan, and he began a series of reforms which he's referred to as the 3 arrows. Basically, with the aid of the Bank of Japan, this encompasses fiscal reform, aggressive monetary policy, and also structural reform in an effort to boost growth and move Japan out of a low inflation / deflation environment into what they're targeting is a 2% inflation rate. We believe they've been, Abe and government, along with the BOJ, the Bank of Japan, has been quite successful in 2 of those 3 arrows, in terms of fiscal stimulus and in terms of monetary policy. The challenge now, and the most difficult arrow to fire, is a 3rd one, which is structural reform. To date, there's been some good signs that they are making progress towards structural reform in a number of different areas. What we believe is going to be difficult for 2% to be achieved in terms of an inflation number. That said, if you look at where the Japanese government bond market is trading today, yields are extremely low. So in terms of where interest rates may rise in the future across much of the developed world, Japan is one of those markets where, given the success so far of the Abe government and their commitment to structural reform going forward, we may see vulnerabilities in the Japanese government bond market from here. And it's one area that we do not see as particularly attractive in the global fixed income markets today. The goal of the new regulations, including Basel III, is really to limit systematic risk in the financial system. Now, what does that mean? From a bond market perspective, it means a couple things. First thing it means is there's going to be less risk-taking in the form of active positions for proprietary trading on the various investment banks or broker houses. And what that means is it's going to be harder to transact in fixed income, and you've got to be a lot more careful about how you deploy resources in fixed income. The other implication of the new rules and regulations is that it's harder to take risk in the market. So as an equity investor, that may not be potentially the best thing, because it's less risk potentially might mean less return. From the perspective of a bondholder, less risk is a good thing, because the less risky a particular financial corporation is, the more likely it is that they're going to pay you back. They may make less money in terms of earnings, but a higher likelihood of debt repayment on the bonds that they've issued. So net on net, in terms of the bond markets as a whole, financials have become higher quality from a fundamental perspective, not necessarily ratings, but fundamental perspective due to the new rules and regulations has actually improved the fundamental credit quality. But on the flip side has reduced somewhat liquidity in the market. So it's important for managers to recognize this and be conscious of how they're trading in fixed income today given the new rules and regulations. We've seen relative stability in Southern Europe and peripheral Europe in general over the past few quarters, really driven by commitment from the central bank, the European Central Bank, to act as a backstop. I think it's premature to say that the volatility in Europe may be over. I think one thing that has changed is the fears of a Eurozone breakup have diminished with this commitment from the central bank to act as a final backstop. So I think the fears and the high likelihood or higher likelihood of a Eurozone breakup have receded. That said, there's a tremendous amount of uncertainty that exists in the European market today, particularly in the periphery. So uncertainty creates volatility, potentially, which creates opportunity. And I think what we've seen recently in Europe is that much of the volatility that's been created either through political, through elections or through bond market activity has been confined to particular countries. It's been more idiosyncratic, if you will, as opposed to more systematic. And that is a change in the market. For debt managers, when you have volatility which is more country specific as opposed to systematic, it does create opportunities. So I do not think the volatility is over in Europe, but what I do think is the systematic volatility may be reduced, and to the extent there is continued volatility, that may present opportunities for investors who can do the work on the country analysis.